This is what we're talking about. Tax treatment for trade losses. I'm not talking about gain. I'm not talking about losses in business. I am not talking about gambling loss. I am talking about trade losses, stock losses, the new stock market losses. You may say that that's just like a gambler doing stock trading. Well, in life, who doesn't take some risk? So the people who took the risk on the stock market, if you have a loss, yes, you come over here. Let's talk about big pictures. So when you have losses, and I want you to think three things related to losses. So number one is the losses is under your personal name, or the stock losses is under your business name. The reason I say that is you could open up your stock trading account under your business. You could have a business, right? You may have a C corporation, and you may even running a S corporation and running a restaurant, but in that company, you have an investment account. So you could have your losses happen under your corporation. But you could have your losses happen under your personal name with your personal ID, and you're receiving these 1099 statement from your brokerage firm. Am I right? So that's probably the scenario most familiar to you. But folks, do you realize that when you are in that situation with your trade under your name, there is two ways you can deduct the losses. Number one way is everybody know you can have a capital loss with $3,000 limitation. So even if you lose for $3 million, too bad, you can only deduct 3,000 a year. Of course, that doesn't mean you're gonna live for 1,000 years to deduct 3,000 a year, because in life you will be, you'll be getting gains, you'll be having capital gains, so you can offset the losses that is already in your system. So it's just not going to be helping you for that year. Let's say if it is a year that you made a lot of money, but you really lost it all on the stock market, and then you don't have money to pay taxes, but the loss only gave you $3,000 deduction, income deduction, so it doesn't work for you, right? You could be in that boat. So that's a regular passive investor route. So if I draw, I would make that one item. So you are a passive investor, you only deduct $3,000 a year if you lose. The other one is what we call the mark to market, folks. And remember I was showing you on the YouTube channel earlier, remember here? And this is mark to market, but this is the previous videos I did, and where we talk about mark to market. So mark to market, if you choose to become a day trader, to be treated as a day trader, have a mark to market treatment, then your losses is not limited to 3,000. Your losses come out as if you did a business and the business has a loss. So no limit. It will offset all the income you have on your 1040. So you may even ended up with a negative AGI because you just lose so much. So under your personal name, you have two ways to go. You are a passive investor, or you elect yourself to be a day trader and to elect yourself with the election called mark to market. Mark to market election is by your brokerage account. Not all of your brokerage account need to be mark to market. So with that said, you actually can close your brokerage account that already elected to be mark to market. So you're no longer running that day trader business. You went back to work. So you're a passive investor. Then you open up a new brokerage account as a regular investor. Then you will start getting 1099B and everything. Then you will be limited to $3,000 again on loss, but on the gain, it will be either short-term capital gain or long-term capital gain. So with that said, you see on the personal side, as a person, when you hold out to do the stock activities with your social security number, and you are actually either choosing yourself to be a passive investor or you choose yourself to be a day trader. And with that said, I want to mention the third one. The third one is what? The third one is the investment account in your business. So you can set up a company and that does investment. I know that people will say, no, you can't, that's illegal. You need to have a license. Let me clarify this, okay? And if you set up a company to do a day trading business and you're only day trading your own money, no one needs you to have a license. But if you are trading like those financial planner agent and trading under certain platform, and then you need to be licensed, with a financial planner side of requirement. If you're trading other people's money, if you have more than 35 people who come to you, you are trading for them, you do need to look for professional licensing. You need to meet professional licensing requirement to do that. But anything less than that, you're doing it for your mom, you're doing it for your dad, you're doing it for yourself, and you absolutely can do that. It is something that you can invest. But a lot of time, in my view of this investment, I'm not talking about the professional investment firms, because those professional investment firm, they're trading is their regular business. So anything in and out is become income and expense, right? I am talking about you are running a Tesla. I'm using Tesla as an example because that's what Elon Musk did in 2021. So Tesla is in the car business, is not in the cryptocurrency business. Am I right? Yes, I'm right. But Elon Musk bought Bitcoin stock, right, in Tesla. When he buy that, is that treated as part of his business running? No, it is his investment. So his business is investing in Bitcoin. So when you are doing investment in your business, say you have a construction company, say you have a restaurant, and if you invest under your business as a way to preserve your money, at that time, and your trading is regarded, and your trading buy and sell, gain and loss is part of your capital gain and loss inside of that company. So one thing I want to draw your attention, there is a thing called impairment testing. Impairment testing means that when you hold certain stock and or cryptocurrency and the value went down, you didn't even sell, but for your company financial statement, you no longer have that value on there. It already went into a toilet. $100,000 become 1,000. And as a financial statement, and you cannot present your financial statement to the banker to borrow money and it says that, oh, I still have this $1,000, $100,000, not worth that much anymore. That's called impairment. When you have impairment in your investment, you are allowed to write it down because it's a business investment. So you are allowed to write it down to the value it should be. So if you invest in Bitcoin for $100,000, on December 31st, your Bitcoin drop into $100, then you can write it down for the difference. Where did you go with that difference? And you may say that, well, what do you mean by writing it down? You mean I can just take the difference and reduce my income? I can just reduce my income. I made a $200,000 profit. You're saying that I can just reduce 100,000 out of the 200,000? Absolutely. That is an impairment write down. Of course, you cannot be just sitting there with your cigar and it goes, oh yeah, I think my investment went down by a lot. So let's just deduct that. And because I make too much money, that's wrong, right? And you want to evaluate that. So what does the evaluation mean really to people? A lot of time, company with a lot of asset and company doing the right thing has an evaluator outside a business evaluator coming in and to evaluate certain portfolios. So that's how Elon Musk does. And he has a team. They tell him that, well, you're $120 million Bitcoin and it should write down for 100 million. And he will write down for 100 million. Then Tesla will not pay so much income tax. But what happens? And if you are running a small company and you just can't afford that $8,500 ticket for doing evaluation, then what you do is you will look at the market. I think for stock and for cryptocurrency, the market value is so clear. It's right there. And you can look for the market value, make adjustment, and to make sure that your book reflected the true value of your business. So that is what the business side of investment does, which is so different from our personal side. Am I right? And so with this talk, this is where I want you to gain a general understanding. And understand that there is a 3 ways towards the losses. So number 1 is to know who holds the loss. Is that the business or is the person? And if it is the person, and how is the person holding the loss? Is that a passive investment or day trader kind of job, right? So those are 2 very different. But in business, and you want to, of course, if you sell them, you definitely already have the gain or loss coming through. But if you don't sell them, you hold them at the end of the year, and then the value went down, then you have an impairment testing to write down the value that went down. But what if the value went up next year and you didn't sell it? And if value went up, you don't adjust the gain. And you only adjust the gain when you sell it. So that is where impairment testing goes one way to income statement and doesn't come back to balance sheet. So it is just stay there until you sold the portfolio.